the only asset classes you need to know when you begin. We're going to talk about investing, explained very simply. Most people want to invest, but they have no idea where to start. Should you buy stocks? Should you buy property? Crypto? Keep cash? The problem is, really, if you don't understand how these actually work, each one of these, you're probably taking on more risk than you even realize. My name is Andy. I'm a former hedge fund manager and money manager, and currently I'm a private investor since 1994. And in this video, I'm breaking down the main asset classes in really plain, simple English. No BS, no hype, no get rich quick and lose your money. Just reality, what these asset classes really are. So, some assets generally help you keep your money to grow. Some protect the money you already have, and other asset classes smooth out the ups and downs, the volatility. There's really no one size fits all mix. The right combination depends on you and your own personality, your personal goals, your risk profile, your timeline. How much volatility are you willing to handle? So let's start with the most simplest asset class, cash. Cash is the safest place to keep your money, but it's really not that safe. And the reality is, you know how much cash you have. You can access it immediately, instantaneously. And that's what cash is perfect for. It's for emergencies, for short-term goals, anything you might need in the next couple of years. But cash has risk. Inflation, which we're incurring now, slowly eats away at the value of your cash. So even though the number in the account stays the same or goes up by 4%, let's say, that money only buys less and less over time. But cash gives you stability. It's not a long-term wealth builder. But for some people, or most people, let's say, for 3 to 6 months, you need to have cash to survive. 3 to 6 month cushion. This is enough for a peace of mind. So this is so it doesn't hold you back. The next idea, individual stocks. And you can go crazy trying to find the next individual stock. And really what you're buying a stock is you're buying really a piece of a real company. You own a piece of that company. If that company makes money and grows, your investment grows. And then the best part is that some of these companies pay dividends, which is like a cash reward for owning them. They share the profits with you. The upside can be huge, but the risk is also huge. One stock can take off, like Nvidia, or it can completely collapse. That's why individual stocks work as a small, higher risk part of your portfolio, not the foundation. And in all honesty, I wouldn't suggest it. It's great if you're doing research and want to try to find the next greatest thing since white bread, but it's really not the greatest suggestion for beginning investors. What I do suggest, okay, is that most people already know about is index funds. And index funds solve the biggest problem with stock picking. Instead of betting on one particular company, you buy hundreds of them at one shot. Like the S&P 500 is 500 companies. The NASDAQ 100 is 100 companies. The market goes up, the investment goes up. When it goes down, and it definitely will go down at points, your investment goes down. But the key is to have a very long-term time frame and to dollar cost average into these. You don't want to sell when things get ugly. You want to have this long-term plan. And the idea of an index fund is when one company has a bump. If you have a whole index, you're not going to get destroyed. Historically, broad stock markets have returned around 7 to 10% over the long term. That's really the long term. There's periods, however, like 2000 to 2010, the market didn't do anything. It didn't really go up, and it'll test your patience. You have to have patience, as this is a long-term game. And you put your odds in your favor when you take this long-term approach, when you do index funds that are simple, low cost, hands-off. You're not trying to beat the market. You're actually owning the market. And for some people, most people I would tend to believe, this is the core growth engine of their portfolio. It doesn't take a lot of brain capacity, and over time, it can make you a lot of money. Another idea, property. One, you can do the brick and mortars yourself, or you can do it without the hassle and you buy REITs. REITs are stocks basically let you invest in property without you being the actual landlord. You're buying shares in companies that own things like apartment buildings, offices, malls. It can even do mortgages. And you make the money from rents or interest, and they pay consistent dividends. There's no deposits, no tenants, no midnight calls about broken toilets or boilers. But REITs are not risk free. No, there's no, everything has risk. REITs will get hit when interest rates rise. But conversely, you don't put all your eggs in that one basket. It's just one part of the puzzle. And it gives you income and it can give you diversification. The next one, gold. Everyone's talking about gold because gold is whatever it is, 4,200. But don't get diluted. Gold can go up like it has been, but for long periods of time, it can lay dormant and do nothing. Gold doesn't pay you any income. It doesn't give you dividends. It doesn't grow a business. So when the markets are stressed or if there's inflation, gold could be a hedge. And that's why investors keep a small allocation around. Maybe it could be 5%. So you can think of it as like a financial insurance. Not exciting, boring, but potentially reliable when things get ugly. And I told you before, at some point, they will get ugly. This is not easy. Not easy investing. The next one to talk about, it's very controversial, is crypto. Crypto is the highest risk asset on this list. It's digital money built on blockchain technology. Huge, huge, huge potential. I'm sure you know someone who's made zillions, but it has huge volatility. Prices swing so dramatically in days and even hours. Some people have made life-changing, amounts of money, and others have lost everything. So right now, crypto is extremely speculative. And if you invest, do it very carefully and do it with only money that you can afford to lose. Take this verbiage into consideration. Warren Buffett and Charlie Munger, the richest men in the world almost, called crypto rat poison. I don't like crypto, to be honest. Another asset I want to mention is private equity, where actually it's an asset class that I would tend to believe should be looked way down in your career, your investing career, and especially when you have a lot more money. Private equity really means when you're investing in private companies before they go public. The upside could be massive, but the negative is the illiquidity. Your money's going to be locked up for years, and the other reality is many of these investments fail. So it's something to really explore later. It's not a first step. Try to keep things simple as possible and stress-free as possible. So here are my takeaways. You don't need every asset class. You need the right mix that fits your own personality, that lets you grow wealth over time. Defensive assets that can protect it. Balance things out. Hopefully you like this video. And if you do, please subscribe and learn from my other videos. Thanks, everybody.